Welcome to the ARMR Report, guys. It's a Monday morning. Thanks for being with me. I'm your host, Brett Rosenthal. This is a show about stock market investing in what I call the millennial age. For those of you who are new, let me just share with you some facts about the show. First, all the information I'm sharing with you, I'm using every day to manage my own personal assets and that of investors that we work with. It's a live trading desk surrounded by screens. The phone might ring. Sometimes I have to take a break. Thanks for bearing with me while I do that. Why do I do this show? I get that question a lot. Honestly, I think that there's a bunch of different reasons, but one of my favorite is that I do this show to keep myself honest. It helps me execute correctly if I share with you the rules of execution and investing for long-term success. I just enjoy it. I enjoy reaching out and chatting with a bunch of you who've called in. I appreciate that. Anybody who wants to contact me, you can always ask me a question right now on this live stream. You can just type it in, or you can go to our website, rosenthalcapital.com. You can find our phone number, give us a call. I'm more than happy to chat. Now, today's show I want to dedicate to risk management, because very often we spend a lot of time on this show excited about different investing prospects, whether it be short-term, whether it be indexes, or whether it be our favorite group investments like cannabis companies or energy companies or what have you. And while it's lots of fun to talk about success and talk about investing themes and get all riled up with the opportunities that are ahead of us, the sad fact is those opportunities pay off over time. And investing in the stock market requires an immediate focus on how to manage risk in the short term so that you can experience wealth creation over the long term. And so I want to dedicate some time to managing risk. We use algorithms on our desk to help us manage market risk, short-term risk. And then I use 30 plus years of experience doing this to manage longer term risk and how I want to structure portfolios. So I'm going to get into some basics of how to manage risk and different types of risk. There's some risk that can't be managed. There's some risk that you shouldn't bother worrying about and focusing on from a probability standpoint. And then there are the real tangible risks and things you can do to manage those risks. So I'm going to get into that today. On our website, on the front page, the landing page, I've set up two easy to use sections for you. One is called our risk management section. Risk on, risk off, monitor, I call it. We have 5 indexes that we've got algorithms for that tell us when to add risk or subtract risk. And in some portfolios, we literally buy the indexes or sell the indexes based on these algorithms. And in other portfolios, we use the information that can be gathered from those algorithms to manage risk in the portfolio. So there's some portfolios that we manage that have zero interest. Some individuals we work with who have zero interest in buying an index. They come to us for the information we gather on individual companies and how we structure overall equity portfolios. But even in those portfolios, if all of our algorithms tell us risk on, we'll go into those portfolios and add exposure to our favorite groups and stocks. And if it's risk off, we do the opposite, obviously. So, I want you to understand that, because when you're watching our risk on, risk off monitor, and I add for you changes with the date so you can see the last time we made a change, and I try to share with you what our focus is on that date. So below that, on our website, below that section about risk, we have our model portfolios at Interactive Brokers. We have 3 portfolios. All of our investing relationships, in other words, clients we work with, they open an account at Interactive Broker under our umbrella and attach to one of these 3 portfolios. And then they immediately start investing using algorithms with those portfolios. And when I say invest using algorithms, what I mean is the algorithms help drive our decisions. So it's still hands-on investing here. We're not hooked up to a computer system that uses AI and just trades. We're building long-term equity exposure, but we're managing risk short-term with the algorithms. So in both sections, I date for you when we make changes, and so you could see what the most recent changes are to the portfolio structure. When there is a market retracement, which we've experienced in the last couple of weeks. So let's just go over real quick for those of you who are new to this process. In the middle of March, we had a risk on across the board in all of our big indexes. Therefore, we put all of our exposure out, and we owned equity exposure risk. My own personal portfolio, I like to put money in the indexes and do it using the algorithms. So when the probability and statistics are in my favor that the reward is worth the risk taken, I'll put capital to work. And then at the start of May, for those of you who have been following these YouTube live streams or listening on podcasts, on Blog Talk Radio, I told everybody I'm taking all of my personal risk in indexes off the table. I'm booking all of those profits. That was right at the top of the market. I did it because of the algorithms. At that stage, they were telling us the reward from here is not worth the risk taken, so let's get the white meat off the table. I didn't disrupt my longer-term investing strategy. I didn't disrupt my longer-term positions in my portfolio, but I took off the excess risk. Now the market drops, 10% on small caps, something less than that in the other indexes. Great. I've got cash in the portfolio to take advantage of the weakness. Let's take a moment to talk about different types of risk, market risk, okay? I haven't put this up on my new blog. I have a blog post for you guys called Rules of the Road. I've been doing this 30 years, and I share with you rules of the road. I haven't updated it yet, but I will by the end of today. Rule number 61. When the market has had a run-up, the first pullback to the 50-day moving average is a key location. And at that location, we start watching our algorithms for a turn back the other way. We're looking to get long again. We're not looking to get short. Shorting happens later. Shorting happens after a big top. I had a lot of clients call me the last couple of weeks, are we shorting? I say, look at the market. We've had a ripping stock market for most of this year. And now we have a 10% correction. That's not a time to get short. This is the first opportunity to get long for everybody who missed the rally in January and February. And that usually leads to some price appreciation of some kind. Now, our job is to read and react, not to guess, not to predict. So I'm not telling you the market's going up from here. I just am telling you that when we get back to the 50-day moving average on the big indexes after a run-up like this, that's where we start looking for the opportunity to put money to work on a risk standpoint, okay? So I'm watching the algorithms closely to see, do they give us an entry point? Last week, we had a couple of the 5 indexes, 2 of them told us risk on. There's the NASDAQ 100 and the IBD 50. Both of those indexes went up. We raised our stops. They came back down Friday, whoosh, stopped out of the positions right around break even. That's okay, totally normal. After a sell-off like this, you get a couple of whipsaws back and forth, even on the algorithms. For those of you who want to use the algorithms as a guide and don't want to trade aggressively, then what I really look for is all 5 indexes to tell me the same thing within a 48-hour period. So 3 might give us a risk on signal day 1, then the other 2 confirm it on day 2. Now all 5 are telling us risk on. That's the best time to put capital to work, where the reward is worth the risk and the probabilities are in our favor. We didn't get that last week, and I tried to share that with you guys last week during the show. I said, look, we have a couple. Let's see if we get confirmation. And if you're following my Twitter feed, at Brett Rosenthal, B-R-E-T, Rosenthal, or hashtag ARMR Report, A-R-M-R Report, I highlighted on Friday that we did not get confirmation. And so it would be best to have powder dry, particularly over the weekend, so we could put capital to work at a better rate if we get some follow-throughs this week. So we have a gap down this morning. So we booked some profit last week, short-term on our desk, trading the S&P. And so the gap down this morning gave us another short-term opportunity to put money to work, which we did, and we're making money again in the S&P. Every time the S&P drops 0.5% or more, and I'm not invested in the index, right? I have my other investments. We're not talking about the longer term fundamental approach. We're talking about index investing. I've got cash in my portfolio. I'm not invested. The market gaps down 0.5% or more on the S&P. I'll have you know, every day like that, I'm looking to put 25 to 30% of my capital into the S&P after the gap down. Every single time. I have stops. I cut my stops if it doesn't work. I have tight stops. But we have algorithms intraday to get us long. So that if the rally up, which is happening right now, all of a sudden accelerates into the close, and then our multi-day strategies tell us to be risk on, we picked up that 0.5% gap in the market. And that's how you build a cushion for all your other investments. I hope I'm not going too fast for you guys. This is not investing 101. This is a more aggressive, professional style of investing. So let's downshift a minute. I don't recommend you guys trade like that. What we're trying to do, you and I, we're trying to take the algorithms and help you manage your risk. So from a market standpoint, there's 2 types of risk that I care about. There's short-term volatility that creates great buying opportunities. And then there's, what is the Fed doing? Okay, so let's get that out of the way first. If the Fed's raising rates and reducing liquidity, there's a massive amount of risk in the market, and we're going to be very defensive. Maybe we're going to be short. If the Fed is on the sideline or adding liquidity, we're going to be looking long every time the market sells off. That's step 1. So right now we have a trade war with Trump and China, and all that does is keep the Fed on the sidelines. And if the war heats up, that eventually will get the Fed to add liquidity. Guys, that's what puts stock markets up. Okay? Just stop listening to the noise around you and the talking heads on TV, and everyone's scaring you about the stock market because, oh, the Trump and China and all this baloney. The market will top, guys, when there's a deal struck with China and the market gaps up on the news and everyone's excited. That will put the top in. I'm not saying that day, but over the next series of days, or could be a couple weeks, that will be the top. You'll look back on that and say, hey, that was the top. Why? Because the economy will heat up, which will allow the Fed to continue raising rates. And every year in the last 10 years, when the Fed's been raising rates, late 2015 and last year, it's been a terrible year for the stock market, or a terrible quarter. Right? Our first quarter of 2016 was a disaster, and then the Fed started to ease their stance. Okay, so put that aside. Now let's focus on short-term risk. When we get X standard deviations above the 50-day moving average, risk is too high, we revert back to the mean. So we want to get capital out of the market and reduce risk when we're far away from the 50. And when we approach the 50 and go below the 50, we start looking to add risk. That's how you manage your risk on the stock market. Now, if we talk about individual stocks, there's two types of risk. There's sector risk, and then there's the individual company risk, right? Is the sector going out of favor because of a major change in some policy, or is it even more in favor because the federal government, let's say, finally decides to take, I don't know, marijuana off a Schedule S1, right? Then you've got big bump up in cannabis companies. But if it goes the opposite way, you get a sell-off, right? So there's sector risk. And then there's company risk, management team risk, execution risk. The only way to manage those things is to stay on top of your companies, to get on conference calls, to listen to what's happening. Everybody can do that. I do it professionally all day long, but you could do it too. Go to the website of the company you love and go listen to conference calls. You'll learn a lot. Analysts ask questions and you'll learn. All right, so I hope that's helped you. I've kind of gone over my limited time here and I've got to hop. I will be sharing with you tomorrow some interesting information on the canopy acreage deal. We're getting closer to the consummation of that deal, so it's time for us to revisit and see if there's any value opportunities in acreage. So I'll discuss that with you tomorrow. In the meantime, to wrap up when it comes to risk management, always use stops. Try to avoid stops that everybody else uses. Always try to put your capital to risk when your reward is high enough for the risk you're taking and when the probabilities are in your favor. It doesn't mean you'll always be right. Sometimes you'll watch on our website, we're long the market and then we're out 2 or 3 days later. Nothing wrong with that. That means the algo is working correctly. It's putting position capital out and it's protecting capital if it doesn't get paid correctly in the right period of time. That's just the nature of the beast, guys. Okay? So I hope that's been helpful. If you have any questions for me, please reach out. Go to our website, give me a phone call if you want. If I can pick up, I certainly will. And I'll chat with you. Send me emails if you have a question. You can always, respond to these live streams. Thanks for being here, guys, and I'll talk to you again. I'm going to try to get on again tomorrow because I think it's worthwhile going over this canopy acreage deal. At the end of this week, there's going to be a data dump that everyone's going to be sifting through for acreage. And it's important we get ahead of that dump and understand what we're looking for. All right, guys, take care. Have a good day of trading.